I guess you could say maybe the stock price moves, maybe it doesn't move, it doesn't matter, but it is trading in exactly the same place at expiration that it was when you put the trade on. This is important because we're going to look at it different ways too with the if called return, but we've got to kind of draw a line in the sand here. We can't have a formula for, well, if the stock is at this price, the return is this. If it's 1 penny higher, it's this. If it's another penny higher, it's this. If it's 33 cents higher, it's this. You can look at that on a P&L diagram drawn by your broker or drawn by yourself. It's a little tough before expiration, of course. But what we're doing here is we're breaking it down and saying, look, just the option component of that, what does that contribute to the trade?
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 50. That which is measured is improved. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. You don't want to miss anything. And if you're already subscribed to the show, you can go even deeper and get more out of what we talk about with a paid subscription. With your paid subscription, you'll get video extra podcast episodes so you can get hands-on video training on things we talk about in the show. You'll get subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account, and you'll get access to our monthly online Ask Me Anything webinar. And you'll get our unusual options activity alerts on options income trades and much more. And the best part is your paid subscription helps keep this show on the air. So I'd like to take a quick minute to thank our newest paid subscribers. A big warm welcome and thank you to Steve F., Nicholas B., Shelley C., and Anton W. To join this list of Wealth Building paid subscribers, just go to wealthbuildingpodcast.com and choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video class, and get on the wait list to get a signed copy of my new book, Build Consistent Wealth with Options, scheduled for release on April 28th, 2026. I'm a lot like you. I know, that's a weird thing to say. I may not know who you are. I might. I get listeners messaging me pretty regularly. And some of our student traders from Market Taker Mentoring that we coach listen to the show, and I know many of them well. But yeah, it's a bold blanket statement to just say, I'm a lot like you. But what I do know is that in at least one way, we have something in common and something really special in common. We both listen to podcasts to make at least one area of our lives better. What a venue podcasts are, right? I mean, we spend 45 minutes or whatever it is doing something we find enjoyable and end up improved in some way compared with where we were 45 minutes ago. It's like we improve by the minute. And if we also have this other thing called binge listening in common, we can measure it on a larger scale by the episode. Listen to one episode, improve. Listen to 10, improve 10 times as much. And sure, not every episode moves the needle the same as another, but the law of large numbers says that with a lot of data points, the delta, that's delta in the common sense, just meaning incremental change, not necessarily the option sense, though I guess it's basically the same thing. But the delta should give us a pretty solid indication of how much one unit of information moves the needle for improving our lives. Tying back to the topic at hand, that's why we have the Greeks, right? It helps us measure those incremental changes to option prices so we can make better decisions, find better trades, manage trades better, and yes, improve our trades. With covered calls and cash secured puts, there are also metrics that help find and manage and improve them. These are metrics or formulas that are specific to covered calls and cash secured puts. And that, wealth builders, is the cave we're spelunking in today. The things we're going to talk about today are for covered calls, cash secured puts, whether we're using the skate objective or the trade objective. So first, here's how this is going to go. I'll list out the covered call metrics and then dive into each of them. Then I'll list out the cash secured put metrics and do the same thing with them. And then I'll share some other metrics that help improve either wheel cog, both covered calls and cash secured puts. And friends, I'm going to be sure to post this in a video extra so that it's really super easy to follow. I will post it as a PDF so you can just simply download it and always have it there as a reference. We're about to dip into some secret sauce. These covered call formulas, they're not complex, but they require doing some simple arithmetic. We have talked about some of these on shows in the past, but this episode, we're going to really concentrate on them and break down exactly why they're important and have them all in one place. For covered calls, I like to use the static return, which is a percentage. The static return is the call time value divided by the stock price. We also like to use the annualized yield, which is just the annualized version of that. It's the call time value divided by the stock price. Take that times 365 divided by the days to the expiration. We're going to talk about the if called return. That is also a percentage. It's the call strike price minus the stock price plus the call premium divided by the stock price. The break even or the cost basis is the stock price minus the call premium. And the indifferent point is the call price plus the call premium. The static return is an important one. The static return basically assumes the stock price doesn't move and is trading in exactly the same spot at expiration that it was when you put the trade on. Or I guess you could say maybe the stock price moves, maybe it doesn't move, it doesn't matter, but it is trading in exactly the same place at expiration that it was when you put the trade on. This is important because we're going to look at it different ways too with the if called return, but we've got to kind of draw a line in the sand here. We can't have a formula for, well, if the stock is at this price, the return is this. If it's 1 penny higher, it's this. If it's another penny higher, it's this. If it's 33 cents higher, it's this. You can look at that on a P&L diagram drawn by your broker or drawn by yourself. It's a little tough before expiration, of course. But what we're doing here is we're breaking it down and saying, look, just the option component of that, what does that contribute to the trade? And then the stock is going to do whatever it does, assuming we don't get assigned. So this is pretty valuable information. And it's pretty easy. It's kind of a yield type formula. Call time value divided by stock price. That's the percentage that you are making on the call versus your investment, which with the covered call is the stock price. Moving to the annualized yield, that's basically the static return, but it only really becomes valuable when annualized. Now, this is something that regular option traders tend not to do. They tend not to really annualize returns, and in a lot of cases for good reason. With some things, it's just weird annualizing returns. But because covered calls and cash geared puts are longer term plays and are investments, not trades, it's really important to annualize them, especially because part of the nature of options is that they change in value by theta, by time decay, right? If we're looking at a 16-day option, well, okay, a good static return might be this. But if we're looking at a 12-day option, I mean, it's not going to be the same because everything else held constant, the call value is going to be less. So it becomes impossible to compare apples to apples unless we annualize it. When we annualize returns, we can compare a 16-day option to a 13-day option to a 3-day option to a 1-year option. And we can compare the 16-day option on this stock to a 16-day option on this other stock. Annualizing the static return to get, again, what we call the annualized yield, that's what I call it, is super important. You want to get good at this? Get in the habit of looking at the annualized return. So again, that's the call time value divided by the stock price. And hey, let me back up a second. Why are we using the call time value? Well, we're using the call time value because the intrinsic value doesn't decay, isn't affected by volatility. In a future episode, I'm going to kind of brazenly describe it as the hedge portion of the covered call, but we're not there yet. So we always want to use only the extrinsic value, the time value. So the call time value divided by the stock price annualized. And the way we annualize is we multiply it times 365 and divide it by the days to expiration. And yes, we use calendar days and not trading days for this. Then we have the if called return. And the if called return is the other scenario. It's what do we make on this covered call if we get assigned? And that's actually a little bit cleaner and more logical because if we get assigned, well, the stock can be a penny above the strike price, or it can be 10 cents above the strike price, or it can be $10 above the strike price, and it doesn't matter. But if it's below the strike price, we don't get assigned. So in a lot of ways, this one's a lot cleaner because, again, the static return, if we don't get assigned, the stock could be at any price below the strike price. That's useful, especially if we're using the trade objective, meaning wanting to trade out of the stock, sell the stock, and get assigned, because that tells me what I'm going to make on the transaction if what I'm looking at ends up playing out correctly. Next, we have the break even or the cost basis. Those, they're not really synonyms, but they're two different ways of looking at basically the same number. If we own the stock and then we sell a call, if the stock goes down, and again, this is not getting assigned, of course, if the stock goes down, we have a little bit of cushion. We still make money on the whole package, the whole covered call, as long as it doesn't go down by more than the stock price minus the call premium. The stock is kind of cushioned by the call premium, and that gives rise to the cumulative discount effect, which we'll talk about later, either in this show or in the next one. So we can look at it as like, okay, I own this stock, which is trading at $100, and I sell a $1 call against it. So if it goes down because I'm cushioned, my break even is $99. My break even on that whole package, long the stock at 100, short the call at $1. When we think about it in terms of cost basis, that's more of a longer term thinking about it. That's saying, well, I effectively now own the stock at $99. And we can think about that actually, really, whether we get assigned or not. It's just whether we add in the effect of the call again later or not. We wouldn't if we think about that as cost basis. And then finally, we have the indifference point. I don't want to make too big of a deal about it. It's important, but it's less important than a lot of people think, because it can make your brain sort of get hung up on maybe arguably the wrong information. The indifference point is this. It's when everything's all said and done and the trade plays out, was I better off having sold the call against the stock or just simply owned the stock and not sold the call? Again, that formula is call strike price plus the call premium. Why? Well, it goes like this. If the stock is below the strike price, I don't get assigned at expiration, but I get to keep the call premium and it expires. And it lowers my cost basis. It's better. But if the stock is above the call strike, well, then I get assigned. And if it's like really, really, really far above the call strike, then I left money on the table and I'm lamenting having sold that darn call. Technically, it's not the call strike price. It's the call strike price where I sell the stock if I get assigned, plus the call premium, which I get to keep either way. But here's the thing. I don't want people to get too hung up on that. Like, you shouldn't lament having sold the call, and you shouldn't be too, oh, I got him, if you don't get assigned. We should kind of keep the emotion out of it, if you will. And by the way, it's called the indifference point because at that exact point, call strike price plus call premium, I'm indifferent as to whether I sold the call or not. But we have adjustments that we can use to buy the call back and sell another call if we don't want to get assigned and the stock goes through the strike price and such. So that's why I say don't get super hung up on the indifference point, but it is kind of a useful data point. Hey, look at that. We covered all the covered call metrics that I wanted to talk about today. We're doing pretty good. Now let's look at the cash secured put metrics. The first one is what I call skate return on cash. Skate return on cash. I would say write that down. But like I said, there'll be a video extra on this. Again, technically not a video. I'll probably just do a PDF. So skate return on cash is a percentage, and it's basically a yield too. It's the put premium divided by the put strike price. Next is what I just simply call the skate yield. It's also a percentage, and just like with the static return on covered calls, and it is kind of akin to it, really. This is just the annualized version of the skate return on cash. So we take the put premium divided by the put strike price and multiply that times 365 divided by the days to expiration. Next is the break even or cost basis, and that is the put strike price minus the put premium. And then we have an indifference point here, which is the stock price plus the put premium. Now let's go through each of these puppies. Skate return on cash, put premium divided by put strike price. So like I said, this is kind of akin to the covered call static return metric. This is presuming we don't get assigned, but this is a little bit tighter because this is an exact number. There's no sliding scale. There's no, oh, if it's a penny higher, well, the stock would actually affect it, because here you don't have the stock. We do know exactly what our investment is on a cash secured put, because if it's truly cash secured, our broker will take the amount of cash equal to the put strike times 100, and we'll set it aside, and we can't trade with that. It's set aside. It's securing the potential purchase of the stock if assigned. So that's why if we divide the put premium by put strike price, what we're doing is, if we assume we don't get assigned, we're dividing our profit by our investment. And that's pretty good stuff right there. But just like with the static return for the covered call, it's got to be annualized, or else it's really, truly not useful. So that is the skate yield. The skate yield is the put premium divided by the strike price. So basically, presuming we don't get assigned, it is literally your profit divided by your investment, and we're going to annualize it. Multiply that times 365 divided by the days to expiration. Now, what's really special about that is that because we're dividing by a known investment, the put strike, we can compare it to not just other cash secured puts of different time horizons. We can do that, yes. And not only other potential cash secured puts in other stocks or ETFs. Yes, we can do that too, but not only those two things. We can also compare it against other investments. Buying a bond, a high yield bond, CD at the bank, an annuity, any other investment that pays a fixed return. They tend to be stated in annualized terms, and that makes the skate return. I would say the skate return is the metric that I use the most often in my own wheel trading, and it's probably the most useful of all of them. Then we have our break even or our cost basis, and that assumes we get assigned on the cash secured put. Because if we get assigned at the strike price, and we subtract out of that the put premium. And I do want to be specific here. We're talking about the time premium only. I was kind of shortcutting that one a little bit, time premium only, because that lets us know, hey, look, if we're looking to get assigned, this is our cost basis, or this is the exact point where we either make money or lose money. So again, it's kind of the same thing, but we can think about it in either of those terms. Very similar concepts, but slightly different. And then finally, we have the indifference point, which in this case is the stock price plus the put premium. That one, if you're looking at the document in the video extra, or if you're writing these down, if you're in a place where you can write these down, don't do it if you're driving or anything, right? You might find this one a little interestingly different. The indifference point is the stock price plus the put premium. Why? Because you don't own the stock. If the stock goes up, well, you don't make money on the stock, do you? Because you don't own it. The most you can make when you sell a put is the amount you collect selling the put. You can only make the put premium. And this is intrinsic and time value, just the actual put premium. So why is the indifference point the stock price plus the put premium? Well, that's different than with the covered call, right? Because you own the stock with the covered call and you're getting assigned. Here, because you don't own the stock, wherever the stock was at the time you made the trade, if you would have bought it there, if you would have bought it there and the stock went up, you would make money on the stock. Once the stock price is higher than where it was plus the put premium, then above there, you would make more money if you would have bought the stock instead of selling the darn put. Make sense? So it's a little different than the indifference point with the covered call. These are old standbys, and there are variations of them. For example, there is a school of thought that would calculate the static return by dividing the call premium by the stock price minus the call premium. The idea there is they figure it's more indicative of the return of the actual cash layout. As long as you always use the same one every time, you're in good shape. Otherwise, for now, don't get too hung up on it. But if you change your mind later, that's okay. There's nothing wrong with it. These are all valuable as standalone metrics, as well as when modified or combined with others. There's one more thing that I want to talk about this week. I didn't know if I was going to have time to squeeze it in, but what the heck? Let's squeeze it in. Why not? And that is the cumulative discount effect. So this is not just for either covered calls or cash geared puts, but specifically, it's when using the wheel cyclically, trade after trade after trade, for both covered calls and cash secured puts. Like, basically, here's the concept. It's the cost basis as lowered by each option premium you collect on each wheel cog. So I'm thinking about buying $100 stock. I sell the 98 puts for, let's just make all the option premiums $1. That's completely unrealistic, but let's make all the option premiums $1, okay? I sell the 98 puts, and what do you know? I skate, I don't get assigned. Great. Now my cost basis, well, I mean, I don't know. I don't really own the stock yet, so it's not really a cost basis thing yet, right? I got $1 in my pocket. Let's just put that in a basket over here. Got to visualize that in a place in your head, right? Okay, now I sell another 98 put. If the stock's higher, I might be selling a 99 put. If it's lower, I might be selling a 97 put, whatever. And I'm probably selling it at something different than $1 too, but let's just make this whole thing easy. Okay, skate again. Great. Now I have $2 in my pocket. Wonderful. Now I sell another put at $1. Oh, this time I get assigned. I buy the stock at 98, but I collected $1 on this trade and $1 on the last two trades, but I really effectively own the stock at 95, right? Because I actually bought it at the put strike price 98 minus the three $1 premiums I collected on the last three put trades, two that skated, one that got assigned. Okay, great. Now I sell the 100 strike covered call at $1 and I skate. Okay, now that discount of all these premiums cumulatively helps even more. I collected another buck. I effectively own the stock at $94. Now I sell another 100 strike call or 99 or 101 and they sell it at whatever the price is. We'll say $1. And I skate. Now I effectively own the stock at 93. I sell another call at $1. Oh, now I get assigned. So I sold the stock at $100. I effectively owned it at, I don't know how many premiums I say collected, 8 or something like that, 92. In this case, I also happened to scalp out $2, buying it at 98 and selling it at 100. And the really special thing here is that because you keep accumulating all these premiums and further discounting what we think about as our cost basis, I'll talk about that in a second, because we keep discounting what we think about as our cost basis, this kind of gives us freedom and flexibility to not get so hung up on which strike we sell. Because if I collected $8 in premium, even if I actually bought at 100 and sold at 98 and lose negative scalp out $2, well, I'm still ahead. I'm still up $6. That would affect my cost basis too, I guess, right? I would have to P&L out all the negative scalps to make it worse for me. And all my positive scalps further improves my cumulative discount effect. But that, friends, that is a super, super powerful thing. The cumulative discount effect is kind of why we do this whole thing, really. I mean, I guess I could say that for a couple of different concepts here. I mean, we do it for the edge, the risk premium, or for planning our exits or whatever, but I don't know. I mean, it's pretty easy to make a case by saying we do this for the cumulative discount effect. Ultimately, the cumulative discount effect is what accounts for lowering our risk, for lowering the standard deviations on these trades, and for improving our Sharpe ratio. So that's a super, super important thing. Now, one little caveat that I wanted to talk about here is that when I say cost basis, I am not talking about the cost basis that you use on your taxes, okay? I am not a tax expert. I do not talk about taxes. I hire a tax professional to do my taxes. I got a lot more things to worry about. So when I use the words break even, effective purchase price, cost basis, those are incidental words that are sometimes used in tax law, but they do not have the same context. This is not the cost basis used for preparing tax documents or calculating anything related to tax obligations. I just wanted to make sure that we are all on the same page with that, just so nobody makes a mistake and thinks otherwise. And that wraps it up for this show. But before you go, please make sure that you're subscribed on your favorite podcast platform, whether it's Spotify, Apple Podcasts, or whatever it may be. And if you'd be so kind as to leave a comment, I would surely appreciate it. Let me know what you like or what you'd like to hear more of. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.